In this video, I'll give you a full trading plan taking you from a beginner to advanced level, covering everything from the framework, timing, trade management, including entry, stop loss, take profit, as well as my favorite model. I also created an ebook that includes everything you need about the strategy, and you can have access to this in the description. If anyone needs one-on-one mentorship, check out the description. This is Mulham, and let's get into this full guide. Now, starting with the prerequisite, there are some stuff or some concepts that you really need to know before going deep into this strategy. And one of those is the fair value gap. So if I go and zoom in here, so coming into the prerequisite first, fair value gap. What is a fair value gap? It's a 3-candle pattern that is created only when the high of the first candle does not overlap with the third candle low. In this case, this is a bullish fair value gap. A bearish fair value gap is also a 3-candle pattern, and it is when the low of the first candle is now overlapping with the high of the third candle. If you're already familiar with those concepts, then you can skip for the next chapter. But if you're not, let me teach you what a fair value gap is. And if you're also not familiar with the liquidity concepts, then I do have a video about all of the ICT basics actually all together. You can watch that video. But simply, this is a bullish fair value gap. This is a bearish fair value gap. And most of the time, this would be filled and it actually give you a better price or a fair value, either buy or sell. So in this bullish example, bullish fair value gap, price goes up, then it comes lower to give you a better price to buy. So it comes to this fair value gap and it actually gives you a fair value to buy. In the same scenario, in a bearish one, the market will give you a better price to sell from this fair value gap here. So it pushes price lower in this case, in a bearish one, and it push price higher. When price comes here, it push price higher to go up. Now, this is the fair value gap. We got to understand what happened when a fair value gap is not respected. So if you think about this, when a support is not respected, what happened? It flips to resistance, right? And the opposite is also true. The same way with, for example, supply and demand. When a supply zone is not respected, it flips to a demand zone. If you're someone who trades ICT concepts, then you already know order blocks. When those order blocks are not respected, usually they switch to, or they flips to breaker blocks. So an order block is bullish, disrespected, then we have a bearish breaker block. So it's always the opposite. We have a support, then when disrespected, it flips to resistance in this case. Now for fair value gap, it's the same. If this fair value gap is disrespected, usually price will now switch to the opposite direction and it will be an inverse fair value gap on the opposite side. So this is a bullish fair value gap. If price comes here and disrespected, then it's going to be a bearish inverse fair value gap in this case. So inverse fair value gap. So this fair value gap, for example, we can see that price did disrespect this fair value gap. Then we have an inverse fair value gap on this case. Now, how do we confirm that we have an inverse fair value gap? It's a closing above or below a fair value gap. So in a, for example, a bullish scenario, then we want to see a closure below the fair value gap. And in a bearish example, we want to see a closure above the fair value gap. So a closure below, and then simply we look for an entry. There are different scenarios to happen after price, creating that inverse fair value gap. There is a rapid move to the downside or the upside in one singular direction, or it could come and retest the inverse fair value gap, sometime to the 50%, sometime to the 25% of the inverse fair value gap, and sometime it creates another fair value gap on the previous fair value gap or the new inverse fair value gap. And we can actually have two fair value gaps aligning with each other. And in ICT concepts, this is called balanced price range. So a fair value gap, a bullish one, then we have another bearish fair value gap, and there is an overlap between them. So two fair value gap overlapping with each other or aligning with each other. Now we got to make sure that we have a singular fair value gap instead of a multiple fair value gap. So on a dealing range or in a fractal high and a fractal low, in between, we want to focus on one singular fair value gap other than multiple ones. And why? Because if you take a look at here, if price decided to go up from here, we have multiple fair value gaps on this dealing range, and price could actually, disrespect this one, but react from this one. It could disrespect this one, the first one, and react from the last one. So it would be disrespecting this, and this, 3 fair value gaps. That's why we need to focus on one singular fair value gap to be disrespected. Even on this case, in this example right here, what do we see? fair value gap here, another one here, and another one here. Even though price disrespected the first fair value gap, which is this one, it went to the second one and started to go up. So we want to avoid this, trading with multiple fair value gaps on a dealing range from this low to this high. We have actually this fair value gap here that was respected, and we have this one that was disrespected. We actually want to focus on the singular one. Even right here, this could be 5 minutes time frame, but on the 1 hour or maybe on the 15 minutes, this could be one singular fair value gap from here to here. And price will just go deep into the fair value gap and come lower. So at the end, this would be, or there is a potential of this fair value gap being respected on the higher time frame. That's what we want to focus on, this one right here. What happened here is singular fair value gap from this low to this high, and right here, price disrespected that fair value gap, then that's confirmed as an inverse fair value gap. We want to focus on singular and not multiple ones. We need to understand this in order to move on to the framework and to the strategy, because otherwise you'd be failing a lot if you just go with the multiple ones and you don't have understanding of the fair value gaps. When you have experience, you can actually move to the multiple ones. But for now, focus on the singular ones. Actually, you can trade the multiple ones. So for example, we have fair value gap here and one here. When price disrespects this one, you can actually target this one. And if price disrespects the other one, then you can look for lower targets to actually look for as a take profit. Otherwise, I would suggest sticking to the singular ones for now. Now, the framework for the strategy, we want to focus on high probability inverse fair value gap. So not any inverse fair value gap, but only the high probability ones. And I'll show you which one they need to be happening on a specific time. They need to be happening on a specific level. We're going to go over those ones. We got to also understand the order flow and the market structure. They're actually related. The order flow and market structure are related. When we have a bullish order flow, usually there is a bullish market structure. So we need to ask ourselves those questions. How are PD arrays respected? How PD arrays are violated? How short-term highs, lows are swept? And how price is disrupting the structure with displacement. So for example, here, price is breaking structures, right? And taking short-term lows, going up, respecting PD arrays that are bullish, and creating another breakout structure. So this is a bullish order flow and bullish structure. On this case, we have price actually respecting bearish PD arrays and taking short-term highs with bearish breakout structure. So in this case, this is the bearish market structure or bearish order flow. So we really want to pay attention to the structure. This is going to help us a lot to look for the high probability ones. But the way that we're going to be looking for the inverse fair value gaps, especially the high probability ones, usually going to be with the order flow and the market structure. But always remember this when taking any trade. Now, the types of the inverse fair value gaps, we have two different types. And as we discussed before, we're not going to be taking any inverse fair value gaps. Not every inverse fair value gap is high probability, but there are specific ones that are very high in probability. Now, first of all, is the price rejected from a fair value gap. So for example, we have price creating a fair value gap, coming into that fair value gap. Then if there is an inverse here, that's a high probability one. We want to see a reaction from a fair value gap, or the second one is price sweeping a liquidity level. That means we have liquidity level, price sweep that one, create an inverse fair value gap here. That's the high probability one. Those are the only two types that we're going to be focusing on, right? Nothing more. So either price rejected from a fair value gap or price sweeping a liquidity level. And beyond those variants, two main ones, there are a lot of other variants that you can actually create with different confluences, including OTE, including some supply and demand, including the other PD arrays, the overlapping PD arrays, a lot of different ways. If you're already experienced with ICT concepts or smart money concepts, you would have a lot of ideas and a lot of other confluences that you can put together in order to get the highest win rate. So this is all we need here. Point of interest, creating an inverse fair value gap. Point of interest could be a liquidity level, or it could be another fair value gap, right? Or an order block. We could actually use order blocks here if you're a fan of order blocks. Now, looking at the two types that we need to focus on, fair value gap, creating another inverse fair value gap, or a sweep into an inverse fair value gap. So looking at the first one, which is the fair value gap and inverse fair value gap, usually what do we want to see? And this is the whole framework. This is all you need to actually trade this strategy. This is your checklist. This is your framework. I do have a full checklist on this book. You can actually have access to it. I mean, you can get the checklist from here. I already wrote everything to you here. So basically what we want to see is price coming lower, creating a fair value gap, and I want to see price coming into this fair value gap. So first of all, bearish fair value gap. As price coming into this fair value gap, I wanted to create a fair value gap. So price is coming into this bearish fair value gap. On the way up, I want to see a creation of a bullish fair value gap, the opposite, bullish fair value gap. We can see that we created a bullish fair value gap here. On the way up to the bearish one, price disrespected the fair value gap with a body closure. So candle closure below bullish fair value gap, making this bullish fair value gap an inverse fair value gap. Then we can look for an entry, and we're going to be discussing the different types of entries. But this is the first variant or the first framework, which is a fair value gap into an inverse fair value gap. On the other hand, we have the other variant, which is the liquidity sweep creating an inverse fair value gap. So basically, we don't have a fair value gap here in this case, but we see price as it's coming up, sweeping a liquidity level. And on the way up, we can see that there is a singular bullish fair value gap. And this singular fair value gap is violated. It flipped from being bullish into bearish. It flipped from being a fair value gap into an inverse fair value gap. So this is the sweep inverse fair value gap framework. Now, I'm going to be moving to, now I do have my favorite model here. It would be available to the people who got the book. But otherwise, we're going to be going to the timing actually and the trade management. So for the timing, we'll be focusing on kill zones, and kill zones are actually times where there is a lot of volume and a lot of traders that are trading the market. So we have Asian, London, New York. Usually I'll be focusing on the London and New York kill zones. All those time are in New York time zone. Then we have macros, and macro is a period in which the algorithm seeks out buy side or sell side liquidity, or it simply rebalance a point of interest, for example, a fair value gap. So rebalancing a fair value gap. And macros could be accumulation, which creates liquidity, distribution, which is an expansion, and the manipulation, which is a liquidity sweep. And we want to focus on the liquidity sweep. So if you want to keep your eye at specific time slots where there is usually manipulation or liquidity sweeps, then those are the ones. London, New York AM, and New York PM. We have those macros here. Keep an eye at those, as there will be some liquidity sweeps at those time zones. And as we know, after the liquidity sweep, there is usually an inverse fair value gap available. Now, when it comes to the trade management, so we're going to be focusing on the entry, on the stop loss placement, and the take profit. When it comes to the entry, different ways to actually enter using inverse fair value gaps. So it could be a body closure. When we have a body closure below the fair value gap, the bullish one, and we are actually inside of a bearish fair value gap, then the body closure, we can actually enter immediately when a body candle closes below. What is the advantage of this one, or the pros? You're not going to be missing trades. The cons of this, it's not the best price to enter. It's going to give you a lower reward to risk, and sometimes it's actually a fake out because we're only looking at one specific time frame. So this could be a fake out and only a week on the higher time frame. Now it could be inverse fair value gap retracement. Sometimes price will come into the beginning of the inverse fair value gap and react from there. There are some times where price will come to the 50% of the inverse fair value gap retracement. I would actually suggest either going with a body closure or the 50% inverse fair value gap retracement. And then there is a high probability one, which is the fair value gap and fair value gap. Two fair value gaps. This is balanced price range, very high probability. We're basically looking for two fair value gaps to be created within the same range. And you can enter either from the beginning of the balanced price range, 50% of the fair value gap, 50% of the balanced price range. A lot of different options here. This is a high probability one that give you a better reward to risk, but you're going to be missing some trades using this one. Now for the stop loss placement, different approaches to follow as well. It could be the swing high or low. So for example, this is the inverse fair value gap, right? It is created here. If we enter using the body closure, then our stop loss would be at this high, above this high. You see right here. Now this is the first approach, and this is actually the safest level to place your stop loss, but it's going to give you a lower reward to risk. Now, another one, but this is very, I would say, manual. This is like mental stop loss. This one is price closing above the inverse fair value gap. So you see fair value gap here. price went up, it closes above the fair value gap here. So that's your stop loss. Instead of waiting for price to take the high, sometime price will close somewhere in here. So that's already a stop loss. It's just the inverse fair value gap violation. So we're expecting inverse fair value gap to push price lower in this case. But if it doesn't and another candle closes above it, that means this is a stop loss for us. So this is a higher reward to risk, but it could be price, sometimes closing above, doesn't reach the high or the swing high, and then comes lower. So you would be actually closing a trade that was in profit and did not hit the real stop loss, which in this case, the swing high or swing low. Now going into the break even, actually a lot of different ways to go for break even, but there are two main ones, and I do follow those actually. So the first one is the rule of 50. For example, we have 4-to-1 reward to risk. When using or when following the rule of 50, basically at the 50% of this trade, which is the 2R, I'm going to be going break even, and I'm going to take 50% of my trade. So after price reaches 50% of the original reward to risk, then we move the stop loss to break even, and we consider taking 50% of the profit. And this is actually optional. So you can move with this without actually taking the partials, only going break even. Or we could actually move our stop loss to break even when price takes the low hanging fruit. So for example, price, we have a clear low here, low hanging fruit. So it's just the nearest low that price could reach to. And it, that price is willing to go there easily. Now, when it comes to taking profit, you got to understand how the market moves in order to, be able to know where to take your profit easily. Now, a simple approach to take your profit is simply the low-hanging fruit. So it's the nearest higher low or the nearest major fair value gap. There is a fair value gap. But if you want a deep understanding about the take profit, then we should know that price move from external to internal or the opposite. Now, what does that mean? You see, internal to external or external to internal. And that's the move. That's the cycle of the market. That's the cycle of the market. Now, what does that mean? That means, first of all, external is highs and lows. Internal is fair value gaps, right? So internal is fair value gaps. External is highs and lows. In this case, we can see that we have this range with an external high and external low. Inside of this, we have the internal liquidity or the internal point of interest. In this case, this is a fair value gap. So you see, after price, going up, it came to internal, goes up, take external. From external, it went to internal, which means that when you are taking an external level, you should aim for internal level. Now, when you are into or inside of an internal level, I'll be targeting actually the external. So my take profit would be here. If I was here in an external, we know that we are now going to internal. So from here all the way to here, that's our internal. So that's how we can actually master the skill of taking profit. Sometimes if you take an entry here and you target this low, a lot of time this would be a protected low and price will not go there. That's why you need to actually target the internal liquidity, because now we know that the move is external to internal and then internal to external. That's the move. Sometimes price will go lower there, yes, but a lot of time price will be respecting this move. External, internal, internal, external, and it goes on and on. Now we also have the checklist here. I'm going to leave this for the people with a book. Let's now focus on the examples. We're going to go over examples, and now the real understanding of the inverse fair value gap is going to come with the examples. That's how we're going to be developing the understanding of the inverse fair value gaps and how to put all of those things together. First example here, this is gold on the 5-minute time frame. Now, the first thing that we need to do is identify a fair value gap, right? And we can actually see that we're having this bearish fair value gap from here to here. And we can see that as price was going up, it created a singular bullish fair value gap. So this is a bullish fair value gap, but it's inside of a bigger fair value gap that is actually bearish. So we know that mostly this would be an inverse fair value gap, and this is not a high probability one. That's where a lot of people would be failing, and they would be longing this fair value gap, where this one is just a trap, just for people to go long, and it gives you some respect here. But then at the end, could be going lower. So that's what happened here. It just an inducement for people to enter long, but in reality, we are in a this would be a higher time frame. So we are on the 5 minutes. We have 3 consecutive bearish fair value gaps. So maybe if we go to the 15 minutes, we would see this as one singular fair value gap. Or if we go to the 30 minutes, this would be a singular fair value gap, big one. Now we see that we have a creation of a bullish fair value gap inside of a higher time frame bearish fair value gap. You see right here. So this is the bearish fair value gap. At what candle is this bullish fair value gap disrespected? And we know the disrespect or the violation of a fair value gap or the creation of an inverse fair value gap comes with a body closure. So in this case, you see no body closure below. Then we have a body closure here. So body closure here with an entry of a body closure, we enter here. Stop loss could be a manual one or a mental one above the inverse fair value gap. So a closure above this level would be usually a stop loss, or we could have above the fair value gap, or it could be above the inverse fair value gap. So just above the inverse fair value gap. It doesn't need to be a closure or a wick. We're having a fixed one here. And that's what I've done here on this trade. This is the trade that I was actually tape reading live, but I could not share it anywhere. But, you know, I saw this happening real time. Now, after this closure, entering from here, what can we target? The low-hanging fruit here. Very clear low that we can actually target, and it's the low-hanging fruit. Now, there's no fair value gap here. There is this one small one here, but most likely this would not be holding. We got to target the low-hanging fruit. And even if this one is holding, it's just a low reward to risk. This is a 2-hour trade. I'll go into the second example, and it's also gold on the same time frame. So 5 minutes time frame. And we follow the same approach here. Fair value gap that is with the order flow. So if you watch my video, you will know that the second fair value gap is a very high in probability. And I do have a specific video about this, about the second fair value gap. What we see here is a fair value gap respected, creating another fair value gap. So this fair value gap was created here. It's a big one with displacement. Price was coming lower. We are also above the Asian high. And we are also above the midnight open because midnight open is somewhere in here, right? Right here. So we are above the midnight open and we are above the Asian high. We could be taking a liquidity level above here. Now we ask this question, as prices coming into the fair value gap, did we create a fair value gap on the opposite direction? Yes. So this is the bearish fair value gap. But what happened here is a creation of a bullish fair value gap. And as I said again, that's where a lot of people would be trapped. They're going to be going long here, but notice that we're actually going down. So bullish fair value gap, but we are already inside of a bearish fair value gap. When there is a violation of this fair value gap, it turns to an inverse fair value gap, and we can actually enter body closure below. This is body closure, entering from here. Stop loss, either it could be above the high or above the inverse fair value gap. I put it above the inverse fair value gap, which is right here. And then we are having a move of internal to external on the higher time frame and on the lower time frame. And on the on this time frame here, on the 5 minutes, we have this internal to where? To external. What is an external liquidity level? We could have this low, or this low hanging fruit here, as well as the Asian low. So anywhere you could hold, you know, you gotta have some rules with take profits. I already mentioned 2, but it could be, you know, your own way of taking take profits. Now, another example on the 15 minutes in this case, and remember that this inverse fair value gap strategy can work on any time frame. So you could go from the daily to the 4 hour, to the 5 minutes, to the 5 seconds. It doesn't really matter because at the end we have the same framework, we have the same blueprint, so it's gonna work anywhere. Now, what we see here is price is going up, and again, we are above the Asian high, we're above the midnight. Midnight is somewhere in here, right? We can see price going up. Now we have a fair value gap here. This one was actually respected. Price went up. Now this one was respected. And why? Because we have another fair value gap that is just below it. So we cannot take this as a singular fair value gap. Those are 2 fair value gaps on in the higher time frame. This is the fair value gap that we're having. It's this big. Now we cannot count on this. What happened here actually is price taking this liquidity level And this is actually at the New York kill zone. This is the London kill zone. So price took the high, and it's a time-based liquidity, which is actually the London high taken here in New York. Now you ask yourself this question: on this range from this low to this high, do we have any fair value gap? And it should be a singular one that is bullish, because the sweep happened to the upside. That means we're going lower, right? And the fair value gap is telling us to go up. It means that one of those should be wrong. And how do we confirm that? When this fair value gap is disrespected, we know that we're going lower. Or if this fair value gap was respected and we take this high and we break out above it with a displacement, that means this is the wrong one. Now what happened? Closure below the fair value gap right here. And what happened inside of here? We actually created another fair value gap inside of the previous fair value gap. So two fair value gaps overlapping with each other. We could actually take an entry from the 50% of the overlapping. We can take an entry at the closure of the candle. That depends on you. Now what I've done here is take a sell limit at the 50% of the balance price range with a stop loss above the high, and then targeting what? So in this case, we could have, first of all, see if this fair value gap is respected. See the reaction. There is no reaction. We can simply see this lower resistance liquidity. So we have liquidity here, and we have more liquidity here where the liquidity was not taken. And then finally, we have the Asian low. So Asian low, low resistance liquidity, that's what we can target. I did target those ones, and this is, I believe it was about 4 to 1. That's the end of the video. I do believe that this is really enough to you. And again, if you wanted to have access to this ebook, make sure to check the description. I left 2 more examples to the people who got the book. I did spend a lot of time putting this together in this way. And also you have the checklist here. I tried to put it together all for you in the easiest way. And I do believe this approach when it comes to the inverse fair value gap is the best so far. You know, I've used inverse fair value gaps a lot, but I've never had a win rate that is as good as this one using any of the other methods. So this is the best way to use the inverse fair value gaps, because it's already giving you an indication of where the market structure is, as well as the order flow. So make sure to use this. And anyway, if you just stick to anything, everything works, right? But you just need to stick with it, master it, and get better at it. Because at the end, trading is a game of probability. I really wish you the best. And make sure, if you don't understand any of those concepts, go again, watch the video again, and take notes, or get the ebook, join the Discord. You can ask me questions there. I'll be happy to answer all your questions. This is Molham, and I'll see you in the next video.